Hello students, how are you all? So welcome to this next lecture of chapter number 9. Now we have started our book number 2, that is part B of your business studies syllabus. The part 1 was related to the functions of management, planning, organizing and all. And in this part, we have financial management, financial markets and marketing. Relatively, each chapter's length is a little longer, but it's very, very simple to understand. In the previous classes, what we had done in the previous classes, we had started this chapter and finished few things related to financial management. Let me just give a quick recap to this and then we will move ahead with today's class. So what we had done in the previous class, let me revise. We had learned, first of all, what is financial management. So financial management is actually management of finances in a business. Okay, so this is what we had learned. Under financial management, it is concerned with the proper procurement and usage of finance. Financial management involves management. Management means we are concerned over here with planning and controlling of finances, and it also reduces the cost of financing. What is the importance of having a proper financial management in a business? First of all, it helps us in telling the size and composition of fixed asset in the business, means how much money should be blocked in the fixed asset, whether we should buy them or we should hire, and so on. Secondly, it tells us the quantum in current assets and its breakup, means how much of cash should be held, how much we should invest in the inventory, what should be the inventory management, from the point of view of finances and all. This helps us in that. Then it also helps us in telling that what kind of sources of finance can be used for taking the loans, whether we should go for long-term sources of finances or short-term sources of finances, and under that also whether we should go for borrowed fund or the own funds, and the amount of long-term and short-term financing to be used and all. Okay, so this is importance. Now, if we talk about the objective, we have seen there are 3 types of objective. Objective number 1, profit maximization, means increasing EPS. Objective number 2 is wealth maximization, and objective number 3 was that the utilization of financial resources in best possible manner. Then we had seen there are 3 financial decisions involved. Number 1 is investment decision. Number 2 is financing decision, and dividend decision is number 3. We have done in detail what is investment decision, that is capital budgeting, which is related to investment into the long-term assets. Working capital management means the day-to-day working of the organization, how it is going to be financed. That and investment decision is done in detail in the last class. This is what we discussed: long-term investment and short-term investment decision. Investment decision involves inventory management, receivable management, effective cash management, and investment decisions is affected by cash flow of the project, that how much of cash inflow and outflow is taking place, rate of return, and investment criteria involved. When we talk about the financing decision, means from where are we going to take the finances? What are the sources going to be? So that is called financing decision. And the financing decision, we decide whether we want to take from borrowed fund or from the own fund, means either debt or capital. And the financing decision, we also saw that what are the factors which will affect the financing decision? That is cost, what kind of risk an entity want to take, flotation cost on cash flow position, and position of the stock market or the capital market, control consideration, and fixed operation cost. This all was done in the previous classes. Okay, so I hope you have revised it well and you are ready to start with the next class now, and today's class, which is with investment dividend decision. The dividend decision is also going to be important and you have to understand it properly. So let's start. So the decision which we are going to study today is dividend decision. We had done 2 other decisions in the previous class. Dividend decision. Now, what is dividend decision? Dividend decision is the decision which is related to the profit earned by an organization, which is our company. So the company has to decide, or the management of company has to decide whether they want to distribute the dividend, the profit earned by them among the partners or shareholders, and what if they want to distribute, if they want to distribute, what is the percentage of dividend which they should distribute among the shareholders. Now you must be thinking that why I am saying if they want to distribute. Yes, it is completely at the discretion of the directors. If they want to distribute the dividend, then only they will distribute. Otherwise, this is also a possibility that in spite of earning good profits, the directors of the company will not distribute the dividend. The reason could be they have very good projects in hand, so they may invest this money. Remember the three objectives of financial management. Number one was increasing earning per share. So if you are distributing dividend, you are increasing earning per share, and if you are distributing good amount of dividend per share, you are increasing EPS of per share. But if your company's objective is wealth maximization of shareholder, in that case, instead of distributing dividend among the shareholders, what you can do, you can invest this money into some profitable projects, so that will meet the second financial management objective, that is wealth maximization of your shareholders. So depending on that, company will decide that what is the objective and how much they want to distribute as dividend. Let us read what is written over here. Dividend is that part of profit which is to be distributed among the shareholder of company. The definition of dividend is given over here. This decision relates to the distribution of dividend among the various groups. Various groups means we're talking about the shareholders only. There are two types of shareholders. In the beginning of chapter, I had told you there can be equity shareholders and they can be preference shareholders. So the rate for preference shareholders by which they will be getting the dividend is always fixed, because preference shareholders are always like debenture holders. They have a fixed rate of interest. Then in the similar manner, the preference shareholders also have a fixed pre-decided rate of dividend. Let's say 10% preference shareholders. So they will be getting 10% part of dividend or profit. But equity shareholders do not have any fixed rate of dividend. So sometimes they may get 2%, sometimes they get 10%, sometimes they get less than that. Okay, so it keep on fluctuating, but still there are some companies who try to keep it fixed. Let us see that in this dividend decision. This decision relates to the distribution of dividend among the various groups. In this decision, it must be decided that what? Number one, if all profits are to be dispersed, means do you want to disperse all the profit which you have earned as a company? Number two, whether all the earnings will be retained in the business. Two extreme cases. First, you are distributing as dividend to a shareholder whatever you have earned. Second extreme case, you are not distributing even a single penny and holding back all the profit which you have earned. And number three, whether a portion of profit will be retained in the business and the remainder is distributed among the shareholders. So students, question yourself and answer. Which situation is the best among 1, 2, and 3? I'm very sure that you must have give reasons to yourself and found out that the third is the balanced decision, because two extremes, holding all the profit with the company and distributing all the profit among the shareholder, both the extremes are not good. So there has to be a balance in the decision making by the company, and for that reason the third alternative is the best alternative which a company must decide. But in practical world, we can see all three types of decisions taken by the company. Now let us see what are some important factors which affect the dividend decision of company. Apart from these three above things, what company decides, whether to hold the entire profit, whether to distribute the entire profit, or keeping a portion with themselves and distributing the remaining, what else are the things, what are the factors which are going to affect the company's decision? Let us see that. Okay. So first of all, amount of earning. Dividend represent the share of profit distributed among the shareholder. Thus, earning is a major determinant of dividend decision. So first of all, there has to be sufficient amount of earnings available to the company. If the earnings itself are very, very less, in that case, it is not possible to distribute the dividend among the shareholders. Okay. So dividend represents the share of profit distributed among the shareholder. Thus, earning is a major determinant. If earning itself are less, obviously the dividend cannot be distributed in a big amount. Stability of earning. See, sometimes the nature of industry may be like that in particular year you earn a lot, and in particular year your earnings are considerably low. So means there is no stability. Such kind of companies will not be distributing very large amount as dividend out of their profit, because of the simple reason, in the years when they earn good amount of profit, they have to save for the rainy days. Means they have to save for those years when the amount of profit is considerably low. Why? Maybe because for the working capital management, maybe for the procurement of raw material and various other things. That is why these kind of companies are not going to distribute dividend in a big amount, and they may completely avoid distributing dividend as well, because that is also a choice. Stability of dividend. There are some companies who believe that they should not keep on fluctuating the rate of dividend for the equity shareholder, like 1 year 10% and 1 year 2%. Instead, they want to keep a minimum rate of dividend, which every year they will distribute. So for that reason, they decide a rate of dividend which is considerably low, because they have to think of the years in which they do not earn sufficient profit, or the profit is not there at all. In those years also, if they want to keep on distributing dividend, they can do it. There are provisions for it in Companies Act 2013. How it is possible? In those years when there is insufficient profit, or in those years when there is less profit, there is no profit, then in that case also a company can distribute the dividend. Now the question must arise in your mind, how company is going to distribute the dividend if there is insufficient profit or there is no profit at all? So for that, previous year's profit, previous year's reserves and surpluses can be utilized for distributing the dividend among the shareholders. So that is the reason companies who want stability in their dividend policy, they always go for a very low rate of the dividend, so that at least that much they can provide to their shareholders. Now, growth opportunities. This I kept on telling right from the beginning of chapter. The companies who have growth opportunities, they normally do not distribute a very big amount of dividend to their shareholders. I had given you example of Facebook and Reliance also, that these kind of companies who have enormous growth possibilities and opportunities, they do not believe in distributing dividends. So their whole target is to focus on the second objective of financial management, that is wealth maximization, not on the first objective of financial management, which is the increasing the earning of equity shareholder, which is increasing EPS for the shareholders. Now, the last point is cash flow position. How is the cash flow position? If the cash flow position is not very stable for a company, it is not wise for that kind of company to keep on distributing big amount of dividend, because they will have to keep enough amount of profit in the reserve so that they can manage their day-to-day workings in an efficient manner. That is why they do not distribute so much of dividend. On the contrary, if a company has regular cash flow, very smooth cash flow, they can go for distributing dividend in a larger percentage. There are some more. I said last. No, that was not the last. There are some more. There are a few more points regarding the dividend decision. That now another point number 6 is shareholders' preferences. Now, what kind of shareholders are there? What are their preferences? How do we come to know? Every year, company calls its annual general meeting. In that, all the shareholders are called. They can be asked over there. There can be other ways of communicating with shareholders, where we can conduct a survey and come to know that what are the preferences of shareholders. If your shareholders are willing to take dividend, then in that case, the company should distribute the dividend on the regular basis. If the shareholders are not interested too much in the dividend, but they want company to invest into good project and maximize their wealth, then company should take decisions accordingly. Means the company whose shareholders are willing to take only the dividend and have the regular earnings, that company should distribute dividend with a larger rate of dividend. The company whose shareholders are willing for the wealth maximization, that kind of company can reduce the rate of dividend distributed among the shareholders and can opt not to distribute any dividend at all and invest into the good projects for maximizing the wealth of shareholders. Next is taxation policy. Dividends are tax-free income. This has changed. So when these notes were made around 1 year ago, at that time, dividend was tax-free income in the hand of shareholders. Now the tax laws have changed. In fact, in your NCERT books, you will find written the same thing. Why? Because that time the rules were different. But now all the dividends are taxable in the hand of shareholders as well. So this particular point, though it is written in the book, but I will avoid teaching this because there is a change in the tax laws of our land. So let us not read this point number 7. Legal constraints. Let us read to the next point. Go to the next point, 8th one. Every company is required to adhere to the restriction and provisions laid by the Companies Act regarding dividend payouts. So I was giving you example a few minutes back. If in a particular year the company has not earned sufficient dividend, or it has sufficient profit, or it has no profit at all, it can utilize the profit from the previous years. But if it has no free reserves, means no general reserve kind of thing, or no free reserve, or no amount in statement of profit and loss account, or negative amount in statement of profit and loss of the previous year's also, and still it wants to distribute the dividend, it cannot do so. It will have to adhere to the restrictions given by the Companies Act 2013. Means, just to give you a clarity of it, let me give you an idea. If a company wants to increase its share prices in the market, or it wants the favor from the shareholders, it does not want in the market that share prices should go down, what it does, it borrows some money just for the purpose of distributing dividend. It will be completely wrong and prohibited by Companies Act 2013. No company can do that it borrows money from somewhere and distribute it among the shareholders as dividend. Because understand the meaning of dividend. Just few minutes back, we had read what is the meaning of dividend. Dividend is part of profit. So you should be a profit-making company, then only you can distribute the dividend. Just for the name's sake, you're giving dividend to the people and creating a fake image of the company so that your share prices are stable in the market. That will not be allowed by any law. So Companies Act 2013 completely prohibits this thing, that no company can, out of capital or borrowed capital, can distribute the dividend among the shareholder. It has to be strictly from the profit of this year or from the previous year's profit or free reserve, no, not from anywhere else. Then next one, what will affect the dividend decision is contractual constraints. What is contractual constraint? Sometimes companies are required to enter into the contractual agreements with their lenders with respect to the payment of dividend in future. For example, companies borrowing from a financial institution. When companies borrowing from a financial institution, that financial institution, while lending the money, keep a clause in the agreement that in future, whatever dividends you distribute, it will not raise by a particular rate. So if the company agrees, then company will have to abide by this contract, and company will have to distribute dividend only below that rate or what is being decided. Let's say company is borrowing from a non-banking financial institution some amount of money, and that institution has put a clause in the agreement that you cannot distribute dividend more than 5% to your shareholders for next 5 years till the loan is being repaid to the financial institution. Then company will have to follow this because it has agreed and signed on the loan agreement. So it will have to distribute dividend less than 5% or 5% every year till next 5 years. I hope this thing is clear to you, students. And the last point is stock market. A bull market or a bear market also affects the dividend decision of the firm. So if the market is on the higher side, what will the firms do? They will, the companies can distribute the higher dividend, or on the contrary, lower dividend can be distributed. So all these factors can be there which will affect the dividend decision by the company, and there can be various other things. Okay, these 10 points are also less because they can be in the practical world. They can be many things which will affect the dividend decision. This is just to give you a broad idea that what are the factors which can affect the dividend decision for a company. I will suggest students to pause over here and reread everything once again so that things are clear, and do not forget to make the changes in your books regarding the taxation policy, because according to the new laws, the tax is levied on the dividend income to the shareholder as well. So now we have completed all the financial decisions. See, let me recap what we had started and what we have finished in today's class. In fact, in the previous class as well, we had started from here as far as decision part is concerned, that there are three decisions related to the financial management. Decision number one is investment decision, which is further bifurcated into two parts: capital budgeting and working capital management decision. Then financial management decision, under which we see cost of capital, capital structure, leverages, etc. And the dividend decision, under which we see what is the dividend policy, how much we should distribute as dividend and how much we should retain with us, means how much of that part of the dividend, that part of profit which the company should not be distributing among the shareholders. So these are three decisions which are concerned with the financial management. Now we are going to the second part of this chapter. The second part of this chapter is financial planning. Till now, we have discussed about the financial management. Now we are going to the planning phase of this. What is financial planning? So let us understand what is the meaning of financial planning. Let me reach to the particular slide here. So what is the meaning of financial planning? We all have studied planning as function of management. So what is financial planning? Let us see that now. Financial planning refers to the preparation of plan to ensure the adequacy of funds at the time of requirement. So whenever we do planning, obviously planning is going to be futuristic. We cannot do planning for things which have already happened, means for the past planning is not possible. So financial planning refers to the preparation of plan to ensure the adequacy of fund at the time of requirement. Means whenever you want to launch a new product, or if there is any urgency, or if there is anything which is, not there in agenda and suddenly it happens, okay, any shocks and surprises by the market, if that happens, for that how we are going to arrange the funds. So that all financial planning does. In case the funds are not available on time, the company will not be able to fulfill its activities. So if any new project is coming up and no planning was done for the finances, obviously the company will not be able to take the new project or any opportunity arising in the market. If you do not have funds available for it, you cannot avail, you cannot make, take that opportunity and make any business out of it. What is the objectives of financial planning? So first of all, it ensures that the funds are readily available at the time of need. It should not be there that there is very good opportunity, but we'll have to leave it because we do not have sufficient funds. Second thing, it also checks that the firm need not unnecessarily raise the resources. It is also ensuring that unnecessarily, just for the petty expenses, the firm is borrowing the money. It should always, try not to, as much as possible, not to borrow for petty things. Okay, it should generate that much of money that the working capital is, flowing smoothly. Let us see further. What is the importance of financial planning? What is the importance of financial planning? It's very, very important, needless to say. First of all, forecasting. What is forecasting? It helps forecasting the future under different circumstances. This helps the firms and organization in dealing with contingency. So whenever we do business analysis, we always think about the future, that what are the things which may happen in the future. We try to do a forecasting that this year the sales was this much, next year how much it will be, this year the expenses are this much. Next year, considering the rate of inflation, the expenses will increase by this much of percentage, and so on. Various other things can be forecasted, and accordingly, we make the arrangement of fund. Let's say we are anticipating the next year sales will increase by 10%. So how the sales is going to increase by 10% if the production has not only increased by 10%? So if you have the vision or aim of increasing the sales by 10% next year, first of all, you will have to produce more goods. 10% more articles needs to be produced. For that, what is required? Financial planning is required, because for producing 10% extra, you need extra funds, and for that you will have to do the planning. So forecasting is done. If you are thinking that by the way inflation is increasing, this year expenses were this much of percent, next year my expenses are going to go high. So you will have to make arrangement today itself. You cannot do something at the 11th hour, because the businesses will fail in this manner. So planning is that important, especially the financial planning is very, very, very important. Prepares for uncertainties. As we said, there can be shocks and surprises. So preparing yourself for the shocks, because in business environment, we have already studied that there can be various factors which are out of our control. Like we can control our cost. how to, how to not to spend too much on various heads, how to reduce the cost, and so many things. But if the raw material itself is available at the higher prices, that cost is uncontrollable cost. We cannot control it because it is totally out of our control. It is in the hand of some external factors which we cannot control. We can control the expenses which we are incurring in the office by telling people, by following the way, so that the expenses in the office can be reduced, the expenses in the factory can be reduced. But if your raw material itself is increasing, in that case, it is cannot be controlled, and for that, good financial planning will help us. Okay, so that way financial planning is very, very required. Next point of importance of financial management, financial planning, is coordination. What is coordination? It helps in better coordination of various business functions like production and sales. That example I gave you just few minutes back. If you are aiming to increase your sales by 10%, obviously you will have to increase your production also by the same percentage. So coordination is possible with the help of financial planning. Any planning will make you chop down the things, and whenever you write down the things, you come across the situations which may be favorable to you or may not be favorable to you. You think in all the direction, and that broadened thinking make you more efficient, and it makes you do proper provisions for the things which are out of your control. Then next is building links. What is this building links? Let us read. It builds a link between the present of the organization and with its future. It also provides a link between the financing and investment decisions on the regular basis. So if we are planning that we will invest into a particular project, for that planning is required. So financial management or financial planning, it tries to build a link between the decisions which a company is going to make, because decision cannot be made in the thin air. Decisions need to be made on some solid ground. So how are we going to make the decision? Like today, if I say that tomorrow I'm going to buy a Mercedes, that is just a wishful thinking, because I cannot buy, for the simple reason I do not have that much of money in my bank account. So similarly, if a business owner is making a decision or they are planning something for the future, first of all, where they have to look at their finances, whether the finances are allowing or not. So there is an alignment, there is a coordination, or there is a link between the decisions to be made and the sources. From there, they are going to arrange the sources. Okay. Easy performance and evaluation is possible with the help of financial planning. It makes the evaluation of performance easier and detailed way, because whenever we do planning, you must have heard that planning and controlling go hand in hand. So if we have to see that whatever was planned, are we able to do that in that manner only, or we are deviated from our plans? So it always keeps a check. Okay, whenever there is something to keep a check on you, the discipline will come, and that kind of financial discipline is very, very important for a business to follow. I hope it is clear from till here. I will request all of you to once again read this, and if you have book in front of you, you can refer to your book also and read all of these points, and then let us go ahead for the next topic, which is capital structure. How capital structure is related to this. Now let's see what is capital structure. Capital structure means the composition of various sources of finance which is present in your company's balance sheet. Means how much you have borrowed from the people, how much you have funded from your own resources like share capital or the previous reserves, surpluses, etc. Let us read what is the literal meaning of capital structure from here. Capital structure refers to the mix between the owners and the borrowed funds. Capital structure is blend of debt and equity, or the borrowed funds and the owner's fund respectively. So how much percentage out of your capital is from the own sources, or how much is borrowed, that it tells. It is calculated as debt equity ratio also. That is debt equity or debt upon equity, or the proportion of debt out of the total capital. That is debt plus equity, total debt plus equity. Now, out of this, we have to understand what is owner's fund, which is equity, and what is your borrowed fund. So let us read what is the meaning of owner's fund. It consists of equity share capital, preference share capital, reserves and surpluses, and as well the retained earnings. So whatever you are borrowing from your shareholders. That is not called borrowing because shareholders are the actual owners of the company. So this is called owned fund. That is the reason it is called owned fund. So, and or whatever you have flowed back means out of profit, instead of distributing dividend, if you have retained, that is also your own fund also or only. So these are all called owners fund. And borrowed fund, when you borrow, it can be from the loan, debentures, various types of public deposit, borrowed funds from the banks and other financial institutions for which there is a liability, like you have to pay interest, etc. What are the features? The cost of debt and equity differ significantly. Obviously, debt, there is a fixed liability, you have to keep on paying interest. Equity means you are not under any obligation to pay the dividend every year or a particular rate of dividend every year. That's not an obligation. The risk involved in debt and equity financing are different. The most risky from the point of view of the shareholders are equity share, but from the company's point of view, the equity is not very risky, but debt is risky because they may have to pay the interest even in case of losses. The cost of debt is lower than the cost of equity. Always raising funds from equity is going to cost you more. Why? Because you will have to control, you will have to share the control, you will have to give them voting rights, etc. Whereas to the people who are the lenders, simply lender, you don't have to give them the high rate of interest when your profit is high. Okay, and they are not going to have any control over the management also. The interest that is paid on the debt is deductible expense while computing the tax liability. So whenever the tax liability is computed, before the tax liability is computed, this interest which you are paying to the outsider is deducted. So your tax liability comes lesser. So you get the tax benefit, whereas dividend is part of the shareholder paid out of tax, means out of profit it is being paid after deduction of profit, whatever after deduction of tax, whatever profit comes, that is being distributed among the shareholders, and then shareholders will pay tax separately. So company does not get any tax benefit on it. Debt is cheaper source of finance as compared to that of equity, but it is more risky. From the company's point of view, debt is a cheaper source of finance because of the simple reason I told you. If your company has earned a bumper profit, you cannot, the lenders cannot ask for the more rate of interest. So it is cheaper. Whatever we have promised, we have to pay only that rate of interest. But it is risky. Why it is risky? Because in case there is a loss, then also we will have to pay interest to the debt lenders of the money. Whereas when we talk about the equity is not cheap. It is expensive because you have to have control. You have to share the control. You have to give the voting rights, and even you may have to give high dividend when there is high profit earned by the company. Default in payment of the interest on debt may result in liquidation of company because the debt holder or the debenture holder or the lender of money, any other financial institution, they have right to sue your company if you have delayed in payment of their principal amount or interest. So it may cause liquidation also for a company, but nothing like that will happen with shareholders. If you have not paid dividend, then also it is fine. Factors which will affect the choice of capital structure. Let us see this also. What kind of capital structure should be chosen by a company? There is no ideal thing which is considered to be best for all the industries. Every business has its own capacity, has its own cash flow position, it has its own ups and downs. So accordingly it is chosen. But what are some general factors which are going to affect on the capital structure, that what kind of capital structure will be chosen by a company? Means more of the dividend, more of the equity share or less of the equity share, more of the borrowed capital or less of the borrowed capital. So there are certain factors which will affect. First of all, cash flow position. So before raising finance, businesses must consider the projected cash flow. So if a company does not have a stable cash flow, it is better for them to go for equity shares. Why? Because on equity shares, you do not have to pay a fixed rate of dividends or something like that. But if you have borrowed capital, you will have to pay interest. So if you do not have regular cash flow, you may be under problem. And as we have seen, the consequences can be serious. Your company can go under liquidation as well. So that is why it is very important to have a regular cash flow if you are willing to borrow the capital. Size of business. Small businesses generally go for retained earnings and equity capital as they go for the debt or borrowed, or as if they go for the borrowed capital, the company has to face the fixed interest burden. So for the small businesses, it is always better to go for the safer sources of finance, which is retained earning or equity shares. Means they will rely more on the owner's capital instead of on the borrowed capital, because it always fetches the fixed liability. Interest coverage ratio. If you are an account student, you must have read this, heard this. What is interest coverage ratio? Means how much is your profit? Is it sufficient enough to cover your interest? It is referring to that also. That only. It refers to the number of times a company can cover its interest obligation from the profits. The higher ICR, interest coverage ratio, ICR means reduces the risk of failing to meet the interest obligation. So if your ICR or interest coverage ratio is high, you can go for borrowed fund. But if your ICR is less, it is not suggested to go for big amount of borrowed fund. Debt service coverage ratio means it indicates the company's ability to meet cash commitments for interest and principal amount of debt. If it is low, then it is not suggested for a company to go for higher amount of debt in its capital structure. Okay, let us see once again what all are the factors which will affect the capital structure of company. Number one, cash flow position. Regular cash flows, you can go for borrowed fund. Irregular cash flows or less cash flows, go for owner's fund. Size of business, small size of business, generally owner's fund. Big size of business can have both the both the things in their capital structure, borrowed and owned. Interest coverage ratio, high interest coverage ratio, company can go for borrowed fund easily. If lesser interest coverage ratio, company should not go for high amount of debt. Debt service coverage ratio, again it is saying that how much of debt service can be done. Debt service means again interest only. So how much of debt service can be done? If it is high ratio, company can easily go for borrowed fund. If it is less, then company should not borrow too much and they should rely more on the owner's fund. Next is return on investment. How much are you expecting that out of this project, how much earnings will be there? If company earns high returns, it is capacity to opt for debt. No, it is debt as source of finance. Okay, by mistake, there is then debt. Okay, so this is a typo error. So if there is capacity, you can pay, your return on investment is high, means your profit is high, you can go for debt. Cost of debt. A company may raise funds from debt if it has a capacity to borrow funds at a lower rate of interest. Why will people give you at lower rate of interest? Suppose you are a very big business, you enjoy a very good reputation in the market. So you may be you may be able to take loans from the institution at a lower rate. So if that kind of facility is available because of your reputation, because of your size of the business, then you can easily go for borrowed fund. But if your reputation is not good, your credit rating is not good, your business is a small business, you get the loans, but the high rate of interest you have to pay, then you should not go for the borrowed fund. Tax rate. Higher the tax rate, more preference to the debt capital in the capital structure. Why? Because you will get the tax saving. Why? Because I had told you before the tax is deducted, interest is deducted first. So because you are deducting a big amount as interest and your profit will come lesser, you will have to pay lesser taxes. But if your tax rate is not very high, then don't borrow money only for saving the taxes. Next is cost of equity. If the company has high risk, its shareholder may expect a high rate of return resulting in the increased cost of capital. So whenever shareholders are expecting a high rate of return, means they are expecting high dividend payouts by the company, and means your cost of equity is high. In that case, company should go for the borrowed capital. But if cost of equity is reasonable, in that case, company can go for equity share capital. Flotation cost. Flotation cost means when you are issuing the debentures or shares, or when you're borrowing money, at that time, how much one-time payment you have to do, how much money you have to spend. So if the flotation cost for equity shares is high, which is normally high, then you should go for the borrowed capital. But if the borrowed capital is more expensive, go for the equity share capital. Risk consideration. If you are willing to take more risk, go for the borrowed capital because it has an associated risk with fixed payment of interest, and whereas there is low risk involved in raising funds through owner's capital because equity shareholders cannot legally say that it is their right to get the dividend. So these are some of the factors, students, which will affect the financing, which will affect the capital structure of the company. Okay, there are few more. This one is flexibility. The choice of debt depends on the company's potential to borrow and level of flexibility it wants to retain for choosing a source of funds. So flexibility means what? See, I had told you earlier also, whenever you're issuing the shares, what happens? You're issuing the shares, it does not have any fixed obligation on the company. You don't have to keep any asset as mortgage and all. But one very big thing happens that they are going to share the control. They are going to interfere in the management because the shareholders will get the voting rights. Plus, these are the permanent capital. Means you cannot buy back the shares. Though there is a provision in Companies Act 2013 for buying back, but only for 25% in a year can be bought back by the company. Okay. So, normally, what happens, the general notion among the people is there once the shares are issued, it is a permanent capital. So that flexibility is not there. So there can be a fear of over capitalization. Means हमको जितना capital चाहिए नहीं था उससे ज़्यादा हमने raise कर लिया. And whenever there is something in excess, obviously there will be misuse of that capital. Okay, so the directors may become reckless and the money will be misused. And there is no flexibility. Means you cannot repay and write off the shares, which is possible in the case of borrowed fund. In fact, if you have borrowed money for 20 years and after 15 years only, you are generating good amount of profit, you can repay it before the term is ended. So that kind of flexibility is there with the borrowed fund, but in own fund, that flexibility is not there. Next point is regulatory framework. What is this regulatory framework? The guidelines, norms for documentation, procedures, influence the decision of the source of finance. So for which more formalities need to be done. Like when I take loan from financial institution, there will be formalities, but lesser than issuing the shares. Because for a listed company, bringing an IPO or FPO is going to be a lengthy process. Okay, it's not easy to raise funds from public. Obviously, you can raise a lot of amount as funds from the people, but you will have to go through a lot of procedure. You will have to make your prospectus, expert signature and all that, then advertisement, listing in the stock exchange, and then finally you will be able to raise money. Whereas the procedure will be much more simpler if you're borrowing money from a financial institution. Okay, so that also may decide that what a company wants to choose. Again, the stock market condition, yes. The stock market, if it is flourishing, everybody is very, very enthusiastic that, okay, whatever, earnings I have, out of that, I should save something and I should invest in the stock market. I will be able to earn a passive income. So it is a good time to issue shares, etc. But if your stock market is not performing well, people are fearful. They think, oh, every now and then the stock market keeps falling. Whatever savings I am putting over there, I may lose it altogether. It is better to keep it in the bank. Then in that case, going for issue of shares or debentures, etc. is not a good time. Capital structure of other companies. Always when we are in an industry, we have to look for the capital structure of the others followed. So that can be one factor which the company decides that in the industry, all the other people are doing this way. That tradition can be followed by the other companies also. Okay. So these are some of the factors which will decide what should be your capital structure. So there are a lot of factors, at least the headings of all of this you must know. I will not suggest any selective study because in your 2-marker questions, this can be asked. So you have to read everything and how it is possible to learn. Obviously, subheadings you will have to mug up. But the inside part, you read it 2 times, 3 times, and then you will be easily able to reproduce the same thing. Not exactly the same, but yeah, you try to memorize the keywords from here. I hope this will be clear to all of you. So students, today's class will keep only this much. In the coming classes, we'll cover the remaining portion of this chapter. Okay, till then, you have to revise everything. Okay. I hope you're going to revise, and when you come for the next class, your previous concepts will be fresh. Okay, bye. Have a great day.